Welcome to the Winner's Playbook with Steve and Josh. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you wish to book a free 15-minute call to discuss your personal situation.
All right, welcome back to the Winner's Playbook. My name's Steve. I'm here with Josh, mate. First couple of weeks back. How was your break and Christmas and New Year, the silly season as they call it?
Yeah, the silly season. Yeah, it was a good break for me, Steve. Obviously, we had a big year just within the business, so I felt like I earned the break. And weirdly enough, I actually relaxed more than I thought I would. Kind of kept the laptop away, which Alana, my wife, was very happy with. But yeah, we had a really big year, so I actually took some time. Was up in Queensland for a little bit there in Hervey Bay, just relaxing. The weather was pretty average though. I think the cyclone had been through the week before, so it was very windy, but nevertheless good to get away. And then the second half of it just down here in Melbourne, relaxing, rejuvenating, went down to the hot springs and just came back fresh last week, just ready to rip into it. How about you?
Yeah, same, mate. Look, the weather was pretty average, but just a couple of weeks down the coast here in Adelaide and on the beach with the kids. And tried to, like you, just try to not think about work for a bit of time. But as business owners, you're never really off. Like you can pretend to say you're off, but if something goes wrong, you got to get onto it.
Yes.
So, mate, last year we spoke a lot about property. Property is always, I suppose, a popular topic in the Australian market when it comes to investing and living, and especially with the cost of property these days, and servicing property has become quite difficult. So I've definitely seen this in the back of last year. But buying property within your superannuation compared to buying it in your own name or in a company structure, etc. We're seeing a lot more of it now, and there's a lot more talk about it, and that's mainly because of the servicing of your servicing of loans outside your bank is quite difficult. What's your take on it?
Yeah, property is definitely a hot topic. Like personally myself, I just settled on an investment property just recently. So, we're well and truly all of the team of advisors, like we practice what we preach. If we're talking about buying properties and growing our wealth, like that's what we're doing for ourselves as well. But yeah, I see a lot in the property space. Like predominantly a lot of my clients are generally in the wealth accumulation phase of life. And if they're really trying to build their wealth, it generally makes sense to buy property as well as a way of, really leveraging up and taking, a small amount of money, say $100,000, which we could invest into the share market, but maybe we instead spread that out and buy an asset worth $500,000 or $600,000 being a property. And naturally, Australians obviously just absolutely love property. And I guess an interesting one was looking at the growth rates over the last 12 months. Interest rates have been going up at the fastest rate we've ever seen. And some of the growth around Australia in the property market has been quite amazing. So I think there's a lot of people kind of with FOMO and not wanting to miss out. So it's definitely a lot of conversations that we're having in that space. But particularly, what are we talking about today? Self-managed super funds. It's a big area that we do a lot of work around when it makes sense for a client's situation. And there's reasons why we do look at self-managed super funds, particularly if people maybe hit their servicing limit in their own individual name and can't buy more property. Maybe it does make sense to consider something like a self-managed super fund to look at possibly buying a property. And I think for us, Steve, at Link Wealth, like we don't generally look at self-managed super funds unless there is a desire and need and it's a right thing to do to actually consider buying property. And again, that we'll talk about, that could be a residential investment property or even for business owners buying a commercial premises and leasing that back to yourself. So what about just the nuts and bolts, Steve, of like, how does a self-managed super fund differ just to your regular fund, just to begin?
Yeah, look, there's not much difference, to be honest. The tax rates are the same. They're governed very similar. The legislation is very similar to normal industry funds or normal retail funds. I think the major difference is now this is your fund. As a person, you've got a lot of more responsibility to make sure it's governed correctly, and you can obviously have advisors in there to help you do that, but you've got to be step up and manage it with your advisors or your partners and just control what's going on, because at the end of the day the buck now stops with you rather than an institution or an industry fund. But when it comes down to the nuts and bolts of it, it's pretty similar, exactly the same. The tax is the same. The way we operate them is the same to our normal industry funds. But as you said, these days you can do a hell of a lot with your standard retail funds, wrap accounts and industry funds that you couldn't do 20 years ago, and now you can do a hell of a lot with theirs. So we've got to have a very good reason. It's got to be in the best interest of the client at all times to open up these self-managed super funds. But if the conversation goes that property is involved and the client's got a long-term view with that property, are willing to hold it, or they can always buy sell within super, that's no problem, but willing to leave the money alone and not get access to it for a long period of time, absolutely, a self-managed super fund could be on the table.
Yeah, and what about some of the minimum guidelines and parameters? And there's no set and right way of doing this, of course, but I know when I'm having conversations with clients, I don't really even bring up the conversation unless there's a few key, items or areas of their life and earning certain amounts of income, stable jobs, maybe got a certain superannuation balance and things like that. So like what are some of the like minimum standards or, things you want to see clients have before you would even open up a conversation around one?
Yeah, I think probably knowledge to start, they've got to understand the finance system, the super system and property system if we're going to buy property. You don't want to be really not educated in that to some level to start with. So if they're not there, we'll educate them before we start doing this process. Then there's sort of a minimum balance situation. So we really need to have a minimum balance of 250, minimum to 300 of a balance to really get it to a position where it's beneficial to the client. There are ways we can build that. If we're not there, we can obviously take equity out of their properties outside super and then do some contributions into super to get the balance up. But also, I think you got to remember, we can have multiple people that can be in a fund these days. So you can have up to 6 members in a fund. So, you can join super with friends or family, whoever it may be. It doesn't need to be your family. It can be your friends. So there's a number of ways we can approach it to get it across up and going, but that's probably your starting point. 250 to 300K starting point, and then we can open up the conversation really from there.
Yeah, and then if we talk specifically then around property, I've had a lot of conversations with people just as of late, and I guess just talking about property in itself, for me personally, when I'm weighing up whether that's a viable strategy for someone, like I like to see that they have a minimum time frame that they're going to be holding that property for before we even think about doing it. And I usually say it's got to be at least an 8 to 10 year time frame that we're looking at here, so we can go the ups and downs in the market. Is that generally a bit of how you approach it as well?
Totally, yeah. It's got to be a long-term view, definitely, with property, whether it's inside super or outside super, right? It's clearly it's a long-term investment, and like buying any growth assets, including shares, managed funds, and ETFs. It's not a 1 to 2 to 3, even 5 year time frame, right? It's a 10-year time frame, and you just got to keep building that asset base over 10 years, and don't worry about what happens in that noise of 1 to 2 years or 3 years. If it drops, it doesn't matter, right? You've just got to make sure you can pay the bills, pay the servicing, pay the loans, and look for the long term of building that asset base for the future.
Yep. And I guess with the self-managed super funds, the big way it differs from your regular super fund is you can actually borrow and take on debt, which is what we're talking about here, and buying properties. And there's obviously a few moving parts there. There's what's called a LRBA arrangements, which is probably worth mentioning. And then there's also a bear trust. So there's a bit of structuring, and this is stuff you need to seek advice in relation to, because there's a few different moving parts and parties that you need to be aware of. But what about talking about some of the borrowing, Steve? What do we, how much can you borrow through an SMSF? What sort of rates are you going to be looking at if you were considering this?
Yeah, so we work with Eddie Maleb, who runs our Link Wealth Finance business. He's the senior broker there. And the good news is there's a variety of banks now that are lending in this space. Look, in the past, you used to have a 30% deposit in a self-managed fund. That's actually increased now to 20%. So you can actually get away with an 80% lend and only 20% deposit. That's actually quite new, that change.
Yeah.
Look, the rates are a bit higher. There's no doubt about it. You're talking, these days, investment loan, outside super residential loans are 6.5% or give or take. You're probably talking the low 7% mark, really, to get a loan. But, as long as it stacks up and we see the long-term benefits of it, that rate while it's important and it's a factor, we definitely, look at all the aspects of the investment to make sure it stacks up.
Yeah, and that's obviously what we're doing as advisors. Like, we're doing these plans long term, and that's the thing I really walk my clients through in relation to this. And if we start, painting a scenario of a situation, say someone's got $400,000 between themselves and their partner, say that is combined into a self-managed super fund. Really, the benefit of buying property through the self-managed super fund is the leverage that you get. So you take your $400,000 of total asset that you may have at this point in time. Maybe you take 20% of that, put as your down payment for the investment property that you're going to be buying, and then you borrow the rest, and then you take your total asset value of say 400K that you've got inside super. And I've worked with a couple of clients and their assets have now doubled within 12 months because they've still got some funds left over in a self-managed super fund, which most importantly, which we can talk about, is still diversified. So we don't want to see kind of everything into the property. We still want to leave some funds left over in cash to, cover any shortfall between rent and other expenses, but also have some diversification. Still got your shares, your managed funds, and your ETFs and so on in there. But it's taken them from an asset base of say 400 to 800 because they've now got money left over. They've now got say a $500,000 or $600,000 property as an example, and then still funds left over in a diversified portfolio. So they've doubled their asset base in 12 months. And then if you take the view of, all right, what about their 400K growing at 7 or 8% per annum, compounding year after year, versus now $800,000 growing at say 7 or 8% compounding for the next 15, 20, 30 years? That's where you see more of the magic happening in that compound interest and that growth. And it's not a short-term conversation that we're having here, but that's definitely how I like to sort of show clients. And I know for us at Link, like we definitely want to keep diversification in there. And what about some of that, Steve? Like with that diversification, like if they've already got property in their own name, yeah, we're still going to consider maybe buying through the super, but we don't generally tend to put every bit of money they've got into the actual property purchase, do we?
No, that's right. It's got to be overarching. Whatever we're doing is in line with the goals that they want to achieve, whatever those 10-year retirement goals are. And that whether it's a self-managed super fund or anything else, we just need to make sure it's all aligned to achieving those goals. And absolutely, that can't just be focused on super. We focus at Link on inside super and outside super money. We definitely want those investments working away with us outside superannuation. And the reason being, like a lot of times people want to create those passive incomes before 60. So if we want to create a passive income and take the pressure off work before age 60, well, we need to focus on outside super because you can't access money from super until you're 60. So it's really important you get the right advice here, because if you're sticking all your money in super and you want to have a passive income stream before age 60, well, that's not the right strategy most of the time. So absolutely, Link, we diversify. And if you're going to go property, you also want to have a portfolio of managed funds or ETFs or what it may be for that liquidity, as well as growth assets at the same time, and also diversification across asset classes, because you can't get international shares, for instance, is totally different to Australian residential property, right? So we need to diversify across those asset classes.
Yeah, I think that's a good point you mentioned about the actual accessing of superannuation. So for anyone listening here, you go out and buy an investment property through your super, there's some strict rules in relation to who can actually live in it, and it all has to be at arm's length. So you can't just slot your sister, say, in that property, so to speak, and have it rented back to you. So there are some pretty critical rules you need to be aware of. But then once it's inside the super fund, you can't access it until the earliest of age 60. But then it's also worth then noting what's happening throughout that time, and the tax rates, which you alluded to earlier, Steve, around superannuation is the most tax efficient environment in Australia, and the income from that asset up until 60 is taxed at 15%. Any income generated or earnings through the underlying fund. But if you did say have to sell that property at any point in time and you've owned the property for over 12 months, you're essentially paying a 10% tax rate on that, because you do get a discount when you've owned the asset for over a 12-month period of time, which is worth noting. But then this is where I do speak to my clients about, in saying, all right, what if we're holding the property to 60 and beyond? Maybe that's when we're going to start thinking about retiring. After age 60, once the super's in the retirement phase or transferred into a pension phase or into a pension account, that property could actually be sold tax-free. And that's where I speak to my clients and go, okay, well, what if we could buy one in our own individual name right now versus inside the super? And maybe we've got a 20-year time frame. And if we say, all right, we could buy for 500K, and let's just take a conservative assumption and say that property doubled in value over 20 years, which is pretty average, but let's just say that's what happened. If you then wanted to sell that property, but the property's in your own individual names, you're going to be up for a fair amount of capital gains tax with that. And you could be paying tax rates as high as 45%, which is a lot. Whereas if that's through the super and you're after you've reached age 60 and say retired or satisfied one of the different conditions of release, you could then sell that property and pay no capital gains tax whatsoever. So you got to really weigh up some of that. And I guess another point worthy of noting is properties these days that you're buying, they're probably going to be negatively geared because of where interest rates are at this present moment. And then you've got your other expenses you're paying with that property. So your rent is usually not going to be covering all of your expenses initially until the rents rise and maybe interest rates come down a little bit. So you might get that negative gearing benefit. So you're funding the shortfall. Whereas if it's in your superannuation fund, your super fund will be funding all of that, and none of that's actually impacting your cash flow and personal life as well, which is sometimes a consideration I am speaking to my clients about, because they've got families and they're very conscious of what's happening with their cash flow. And maybe that is then possibly a reason why, we consider maybe doing the property via the SMSF, because none of it actually impacts their personal cash flow, so to speak.
Yeah, exactly. And Josh, have you got any examples recently that you've worked on with clients with setting up a self-managed super fund?
Yeah, I've had quite a few. And I guess just talk about the key members of that team. It's not just us doing all of that work as well. So there's the clients, they've got their responsibility. The advisor's more of the visionary and setting out those plans and whether or not it's even a viable strategy in the first place. But then who else is in the equation for a self-managed super fund? You're usually going to have your accountant, of which we do have those, obviously services at Link Wealth Group as well. Your accountant setting up the actual entity, setting up the self-managed super fund. Usually there's going to be a corporate sort of structure with that as well. So all of that gets set up by your accountant, and then you also might have a buyer's agent actually helping with the underlying selection of the property. So I've had a handful of clients just in the last probably quarter alone who have done exactly that, and they've been a mixture of those in probably in their 30s, 40s, and some even creeping into their sort of late 40s and early 50s, but all of them of which they're going to be holding that property long term, no real vision of actually ever probably selling that property until retirement. But yeah, for me, they've all had good, healthy balances, really good, stable jobs, a nice amount of contributions going into those superannuation funds, a certain level of definitely financial literacy, but they don't try to do it all themselves as well. And funnily enough, I had a conversation with a person just a couple of hours ago around this who's been trying to set up a self-managed super fund and buy a property, and there was some immediate red flags when I was speaking to this individual around their balance was quite small, in my opinion, and they were getting issues around pulling money out of super, and an accountant had sort of set it all up before it should have even been done. So you got to get your team around you right, I think, before you consider going on this journey, because there's a lot of things you got to be aware of, and that's why you've got your advisor, you've got your accountant, the mortgage broker doing the loan, and you might also have a buyer's agent that you're working with. But we're speaking a lot about buying residential property, Steve. Have you had any clients in the past, business owners that have done commercial? Have you had that before?
I have, yeah. Factories in particular. I've had a few factories. So I've had mechanics. I've had construction guys buying their own housing for their construction equipment, things like that. So yeah, it can be a very common strategy, and to be honest, a very good, favourable strategy, that one, because it's tax effective. You own it, you're renting it from yourself effectively. It's the only time you can do it with super is use it yourself as your business owner. Yeah, I've only seen quite positive things from that occurring. It's been a very, very good strategy for some of my clients.
Yeah, and is there any, I suppose, drawbacks or the restrictions on the self-managed super fund side of things around, all right, well, can I go and buy property and could I knock it down and start developing it, or could I, put a granny flat out the back? So I know that the rules around that, you got to be very careful, because that's a common question we get, is developing and things like that through super. What's just a bit of what you need to watch for there?
Yeah, you've got to really do your numbers and make sure you get the right advice here, because if you get stuck, it can be huge penalties if you get it wrong. But in a nutshell, if you're lending money, you can't develop the property. So you can't make additions to the property. You can't do any construction on the property, etc. And most people lend these days to do any of that type of stuff. So it really has to be an existing building or factory or whatever it may be that you're buying. Look, the risk is that clearly there's a legislation risk, because they can change the rules. And once you've got your money into super, you can't get it back out until you're age 60. So, look, that can be an issue. Hopefully they don't change the rules too much with that sort of stuff. And we haven't seen significant changes, really. I don't feel. But clearly the biggest one is you can't get the money back out until a certain point in time. So if you did want to use that money for any particular reason, you actually can't do it. and you definitely don't want to break the rules and go that way, because the penalties are huge and you wouldn't want to go there. So that's probably the major ones, but just getting it right and just making sure it's part of the overall strategy, I think, is key. Don't walk into getting a self-managed super fund just because you've got your eyes focused on a self-managed super fund. It's got to be part of the overarching wealth generation for the family, and getting everything tied in together is absolutely key when it comes to a self-managed super fund.
Yeah, no, totally agree. And I think that's sort of good to end on, Steve, is, a lot of clients that we're working with doing this, like they are typically buying properties that there's really no maintenance with, because they're generally going to be, long-term holds is generally what they're doing. But I think the key message here is just, speak to the right professionals before diving into something like this yourself, because even for us, the rules are always changing. We need to stay up to date with all of that and how it all really looks and feels. So I think a key note is you just got to have your professionals around you and have that team there that can manage it all for you, so you don't get stung with any of the things that can go wrong with a self-managed super fund, which ultimately I have seen people that set them up 10 plus years ago that should never have had one in the first place, and it's all gone wrong, and then they have to wind it down, and there's cost to set them up. Of course, it's not cheap just to set up a self-managed super fund, and then there's also your ongoing costs that you need to weigh up in terms of the ongoing maintenance of it. So before we close out, Steve, anything else worthy of noting on the SMSF side?
No, look, they can be a very good wealth generation strategy, very, very good, and they can really benefit the right person. Do your numbers, get the right advice, and well worth looking into.
Couldn't agree more. So guys, that's all we've got time for today. So obviously this is just the first podcast back. Please give us a follow on all of the social medias, Spotify and Apple as well. 5 stars if you're actually getting some value in relation to this. And as always, if you do want to actually chat about your personal financial situation, go onto the website Link Wealth Group, and you can take your pick of the actual financial advisors. It's not just Steve and myself within the business. And Steve likes to think he's a little bit better looking than me, so you can be the judge of that and choose who you want to speak to. But as always, guys, feel free to come through to us if you do have any questions in relation to this. And Steve, I'll see you on the next one.
See you, mate. Bye.